All righty. So welcome, ladies and gentlemen, and beautiful people. I want to welcome everybody officially to day one of our FX Breakthrough Bootcamp. I'm going to be your host, your trainer, your presenter, your coach. This day, my name is Manny Quinones. I have been trading in the financial markets for close to 10 years. So I'm very excited to be able to be here with each and every single one of you guys that are tuning in here to be able to level up your trading game. So if you guys have found your way here, that means that you have made your way here to the GFU opportunity. You're somebody who is looking to seriously excel. You guys understand that the power of trading in the financial markets is not a get rich quick kind of thing. It's something that you do get wealthy with over time. And it does take a little bit of time. It does take a little bit of effort. But what you can generate here, if you guys transform yourselves into a professional in the market is quite profound. You know, the transformation it can have in somebody's life. So I see that we have people here tapped in from UK. We have Bronx. We have the Spain state of Florida that is here as well. Atlanta. We have some New York. Berlin, Germany is here. We also have France, Wales, Norway, Chicago, Utah, Arizona, England. I believe I said Germany, Chicago, South Texas, Toronto, Canada, Cambridge out there in UK. Very excited to see everybody here. South Africa is here. North Carolina, Amsterdam, Harlem, Australia, Mexico. Wow, we have people tuning in from all over the globe. Very excited to be here. Italy is also here as well. So very excited to be here with each and every single one of you guys. Switzerland. All right, you guys are having a lot of fun. So, all right. So what we're going to do is we're going to get ready to dive into this. Now, if this is your very first time coming here, you guys are in for a very special treat towards the end of this FX training. All righty. Now, again, what we're going to begin here is we're going to begin a 5-day FX Breakthrough Bootcamp. And this is going to be part one of day one. All righty. Which this is going to cover all of the basics within the financial markets. So if you're somebody that is totally brand new to the markets, you do not have a clue what Forex is, what day trading is, how big the market is, how you're able to execute on trades within the market, how you're able to protect your money, your assets, right? How to multiply those assets, how to earn, take profits in those markets. That's everything that you're going to learn and encounter on today's training. So I want you guys to make sure that you sit back, that you're really dialed in. Do not miss a second of this training. Make sure you have a pen and paper as well, so you can continuously take notes on today's training. All right. So as we begin, let's get ready to just jump into this. So the first thing that we're going to ask is, well, what is Forex actually? So we're going to read off the slides here. So Forex is short for foreign exchange. 4X. FOR stands for foreign. EX stands for exchange. So Forex is short for foreign exchange, and it refers to the global decentralized or over-the-counter, what we call OTC market for trading currencies. So this is very similar to the stock market, but instead of trading company shares, we're trading countries' currencies, right? So very, very similar concept, except we're in a much larger, much more global market over here. So the Forex market is the largest, most liquid financial market in the entire world, where currencies are both bought, sold, and bought on the exchange. So Forex trading involves the simultaneousness of buying of one currency and selling of another, with all currencies being traded in pairs. All right, and we're going to learn a little bit more about that. And now the market is actually open 24 hours a day, 5 days a week. So let's take a look at the actual opening and closing of the Forex market. So as we see here, the foreign exchange market operates 24 hours a day, 5 days a week. So essentially, what does this mean if you are a day trader? This means that you have the ability to position yourself in the market 5 days a week, regardless of the time of day. And you're able to actually participate in the market and potentially earn some money. So now, due to the different time zones across the world, this is where it actually opens and closes. So the market open is in Sydney, Australia on Monday morning, local time to Sydney, Australia. And then the market actually closes in New York, in USA, on Friday evening, local time. So this is the actual opening and closing of the market. Now, if you are based here in the States, an easy way to put it is that the market opens on Sunday at 5 p.m. EST, and the market closes on Friday at 5 p.m. EST. Okay, so if you are in a different time zone, you can simply, add or minus your UTC, GMT 1 or 2 to figure out what time zone this is for you when the market opens and close. Now, over the weekend, while we're unable to participate in the foreign exchange market, this is where the institutional activity is taking place, which you're going to learn about in a minute. So banks, other big institutions, they are continuously trading in the market, and they do so mainly on the weekends, while we're able to participate Sunday through Friday during the market open. All right. Now, as we go from here, well, how big is the foreign exchange market, right? This might be my first time looking at it. Many people know about the stock market. Many people, they would have to get in on Amazon and Tesla and Walmart, when they were trading at just penny stocks, when there was initial company offering and it was worth just a few dollars. Can you guys imagine if you guys were getting in Tesla or Amazon when it was $1, $2, or $3 a stock? That's what everybody's looking for now in this day and age. They're looking for that next big tech company, and a lot of people are investing their money. But most people don't know that there is another market that is larger, that is more liquid, that is open longer, and has a bigger profit, a bigger opportunity to earn, while there is a bigger opportunity to lose. But let's talk about how big Forex market is. So the foreign exchange market is one of the largest financial markets in the entire world, right? The daily trading volume in the Forex market is estimated to be over $6.6 trillion a day, according to the 2019 Central Bank survey of FX and the OTC, the over-the-counter derivative markets. So this is phenomenal, because when we're talking about $6.6 trillion, what we're actually talking about here is we are talking about all of the world's wealth, all of the money in all of the banks of all of the countries around the entire globe. We're talking about the total global market cap. This is how much money is in circulation. And every single year, money continuously gets added to the foreign exchange market. So this is an industry that continues to grow. So you have access to this huge market, and every day you get to play in this market. And if you are able to earn a profit, you can earn a significant profit in this market. So if you compare the Forex market now to the stock market, the commodities market, the bond market, which was what many people know of, the foreign exchange market is actually 110 times larger than the other stock exchange market, which is huge. If you guys think about that, there is no market bigger, there is no market better than this FX market. All right. Now, when we go over here and we talk about the history of Forex, well, how did Forex come about? Forex is great. It's big. It's volatile. There's a lot of money in it. How did the Forex market actually exchange? And we created a compact summary over here for you guys. So if we take a look here, it says that the foreign exchange market has a rich history and evolved alongside changes in the global currency system. And it first started with the barter system, which means centuries ago, at the brink of civilization, when primitive people started coming together, they had no wealth, no money, no coins, no commodities. They had nothing to trade. It started off as a barter system. Hey, I might know how to farm. You might know how to do this. I might have some fish. You might have some stones. And that's when foreign exchange actually began. That's when the trading system began, right? And this is where they exchanged goods and services. Later, there was a coin system, a gold coin standard, which was established. And this is what actually established the value of currencies based on gold. Many of you guys may know that, right? So before the gold standard was abolished, every single dollar used to have to be backed up by gold. Now, what happened was the Bretton Woods systems came, and this was after World War II, right? And this is what ended up pegging the currencies to the US dollar. And long story short, oh, it actually has it here. In 1971, the Bretton Woods system collapsed, and this led to the free floating system. Now, basically what happened is on the brink of World War II, we needed to print more money, but there wasn't enough gold to back every single dollar. So that system completely collapsed because we needed to make more arsenals, more jeeps, more things to go into war, and we needed more money. So that's where they started printing more money, and everything ended up collapsing. And then this is where it led to the free floating system. And this is where currency started to fluctuate based on market demand. All right. And then the Plaza Accord of 1980 aimed to devalue the US dollar, impacting global economy. So long story short, as different economies started merging overseas, you had the American economy, the German economy, the European economy. You know, you had all these different economies that were evolving. And what happens was we didn't have one system to say, if I have this much gold and you have that much, you know, silver, how do we know, you know, that there's an even exchange over here? So this is where the free floating and the Plaza Accord came into place, where we established a fair trade across the world. So, you know, this much silver is worth this much gold. You know, these many pennies is worth this much copper is worth, you know, this amount for a dollar. There ended up being a fair, equitable system around the entire globe. And this is where foreign exchange just continued to grow, because now people continuously traded goods and services and values. But this is what happened. Along came the internet, right? And in 1996, right, the rise of the internet actually enabled the development of online trading platforms. Remember America Online? For those of you that are there, right? America, good old dial-up, and it was extremely loud, right? So as you guys remember that, long story short, along came the internet, along came America Online, and along came digital Forex trading. And this technological leap made Forex trading accessible to individuals worldwide, shaping the market into the vast, decentralized financial network that we know today. So this is really how the foreign exchange system has come about. And little by little, we are going from electronic money, and we are now going into cryptocurrency, which is why you not only see people trade currencies and stocks and commodities and bonds, but now you're seeing people trading cryptocurrencies in the market as well. All right. Now, as we move forward for here, what exactly is traded in Forex? So let's talk about it just a bit here. So in the foreign exchange market, currency pairs are traded and quoted together. All right. Now, remember, and this is what it says here, currency pairs are a combination of two countries from two different countries. All right. So, for example, with Euro USD, EUR USD, that is the Euro country, the Euro currency of the Eurozone, right? And the US dollar as the currency in the United States. So if you're going to buy and sell the euro to the US dollar, these two currencies from these two countries come together and they get quoted in a pair, right? So that's why you'll see us say Euro USD, all right? Now, however, besides currency pairs, exotics, indices, cryptocurrencies, metals, commodities, stocks, they're all available to trade, all right? So if we look over here, we have something known as major currency pairs. So what's a major currency pair? A major currency pair is any major country around the world, okay, that is trading their currency to the US dollar. Now, right now, the way that it stands is the dollar is the world currency reserve. So the dollar is the king. USD, the United States dollar, is the world currency reserve. So everything rises and falls based on the value of the dollar. So some of the major countries around the world and some of the major pairs that we trade are Euro USD. This is the euro to the US dollar. GBP USD. This is the Great British Pound to the dollar. USD JPY. This is the United States dollar to the Japanese yen. USD chef. This is the United States dollar to the Swiss franc. USD CAD. This is the US dollar compared to the Canadian loon. AUD USD. This is the Australian dollar to the US dollar. And then we also have the New Zealand, which I believe is the Kiwi, to the United States dollar. So what we do to quote these pairs in short titles, as instead of just saying it all out, we have abbreviations. So we would say the first letter of each pair. So if I say, hey, we're trading EU, that means that we're looking at Euro USD. If I say, hey, we're looking at UJ, that means we're looking at USD JPY. If I say, hey, we're looking at NU, we're looking at New Zealand to the US dollar. So these are the major currency pairs. Now, we also have something called cross-currency pairs, or what you would call minor currency pairs. So I believe there's about 31 to 33 minor currency pairs. So these are all of the currency pairs that are quoted together that does not include the dollar. Remember, any currency pair that includes the dollar is a major. If it does not include the dollar, it's considered a minor, right? So if you're looking at over here, here are all the euros. You see we have EG, euro to the pound, euro chef, EC. This is the euro to the loon, right? Euro CAD, right? Sorry, that's to the chef. So sorry, to the franc, and then to the loon, right over here. So this is all currencies quoted, not including the dollar. From here, we also have something known as exotics. Now, exotics is something where you are taking what they would call undeveloped countries, right? Or undeveloped economies, and then you're trading them, and they call them exotics. Now, I don't want to necessarily say that these are undeveloped economies, because you look at something like the Hong Kong dollar, I wouldn't call that an undeveloped economy, right? So they just call it exotic pairs. So it's an exotic pair. It's something out of the usual. Now, exotic pairs are not as popularly traded, but they can be traded. And now when we look at things like indices or cryptocurrencies or metal, just for you guys to get a better example of the market, as we actually come over here and we take a look at the live market, I'll show you something over here. What we're looking at here is known as the DXY. The DXY, this represents the value of the United States dollar at this current moment right now. Right now, if we take a look at a major currency pair, like let's say GU or EU, you'll notice it looks almost exactly identical. Here goes the GBP USD, and here goes the dollar. Now, let's take a look at something like gold, right? Because gold is actually a precious metal, right? You'll see gold looks almost identical. Let's take a look at something like oil, right? You'll see oil looks almost exactly identical. Look at something like gas, identical. Let's take a look at Bitcoin right over here, right? Take a look at Bitcoin. It looks almost exactly identical. Now, why is this? It's because when we are trading all of these currency pairs have a particular value. And what you're going to learn throughout the rest of the training video today is you're going to learn how the value of all of these assets fluctuate. But this is how they look. When you're looking at the actual financial exchange market, you get to see that the value of everything, every single commodity, every single metal, anything that has a value to it that can be traded, will be traded in the financial exchange market. And this is how you're able to look at the actual price of what it's valued at. And we'll get into that a little bit more. Now, from here, who actually is involved in the financial exchange markets? Who's involved? Who trades? It's a great big worldwide market, right? It's been around since the beginning of time. Who trades in it? So we have 4 major players in the financial market, and we're going to start from the top and work our way down. Now, the number 1 people that's involved in the FX market are actually what we call the intermarket banks. Now, different people, different trainers, different curriculums might have different names, but this is the actual name of them. It's called the intermarket banks. This is also known as the super banks, or what we as traders would call the whales, right? These are the whales. These are the people that enact the majority of FX transactions and control the major money flow of the market. These entities are Citi, right? Citibank, JP Morgan, UBS, Barclay Bank, right? I never pronounced this right. The Dutch Bank, right? Deutsche Bank, Goldman and Sachs, HSBC, Bank of America. Maybe some of you guys bank with these banks. If you look at something like JP Morgan and Chase, I believe JP Morgan and Chase, within their accounts around the world, I believe they hold upwards of like 20 to almost 30% of all of the money in the world is actually held in banks in JP and Morgan. So if you take all the people around the world, all the Joe Schmoes, all the corporations, all the billionaires, right? You take that all up and down, they're holding total in assets almost 30% of the entire world's money. And you know what they do with the money that we hold in the bank? They go and they trade that money in the bank. They leverage our money in the bank and give us something known as a debit card because the banks are indebted to us. That's why the banks have special programs like, hey, maintain a minimum of $100, maintain a minimum of $2,500. Oh, you're a private client, maintain a minimum of $250,000 in these bank accounts. They do that and they don't want you to go below those fees. And if you go below those fees, what do they give you? They give you a penalty. Do you know why they give you a penalty and an overdraft fee? Because they need to ensure that that liquidity, that money, that equity is there so they can trade it within the markets. They're the biggest participators in the entire market. Now, below the intermarket bank or the super banks, we have governments and central banks. These are things known as the European Central Bank, the Bank of England, and the Federal Reserve. Okay, they're regularly involved in the foreign exchange market and their operations, while central banks affect the Forex market when they adjust interest rates and control inflations. So these super banks are working with these huge central banks, and these huge central banks are governing all of our economies within the world. And they're the ones that's controlling the inflation and the value of your currency in your country. Okay. Now, below them, we also have multinational corporations and fund managers, right? So these are people that do business internationally, that have to take part in the foreign exchange market to transfer funds for imports, exports, or services, or extremely large fund managers. So these are companies like Coca-Cola. If Coca-Cola is based in the United States, and let's say Pepsi is based over here, let's use Coca-Cola. If Coca-Cola is selling their products in the European Union and they sell, $50 billion in Coca-Cola products, but they are a US-based company, when they're earning all of those euros, they have to trade those euros back to United States dollars to have their profits to pay out their employees. So this is why they are huge participators in the FX market. And fund managers, these are hedge funds and institutions. These are companies like, if you guys remember Bernie Madoff. Bernie Madoff he had one of the largest pyramid schemes in the world. He had all these wealthy investors, billions of dollars that he was supposedly making money and trading and doing all these things, but he had one gigantic pyramid scheme, right? And he was just taking money and paying people out from it. But legitimate funds, these are corporations that say, hey, for $1 million, $5 million, $50 million buy-in, we'll trade your funds and we'll give you back 7%, 10% a year on your money. Just leave your funds with us. And this is what wealthy people do. So these are very large players within the financial markets. And then now from there, we have the tadpoles, right? That's individuals like you and I. We're known as the retail traders. So retail traders account for a much lower volume of Forex transaction in comparison to the banks and many of these other organizations above us. So we use both technical analysis and fundamental analysis, things that you're going to learn, right? Working with us here. And as retail traders, we aim to profit from the Forex market fluctuations. So that means that we are just little tiny tadpoles playing in the game of Forex. So while the intermarket banks and the central banks and the corporations, while they are taking these markets up and they're taking these markets down, what we do is we use something known as an analysis, which you'll learn later. And by this analysis, we're able to learn how to read the actual price movement. And when we can read the price movement, we're able to forecast where the market's going to go. Where do the banks want to take the market? Where do they want to drive the market? Right? We're almost like newscasters, weathercasters. We get to forecast where the market's going to go. And if we forecast correctly, we're able to earn a profit. We're going to learn about that. So we're just these little people playing in a big game. But now when you actually look at Forex traders and you look at some of the wealthiest Forex traders around the world, you'll come across people like Mr. George Soros, right? This is an individual who has profited $1.3 billion in day trading. The same thing that we're doing is the same thing that he has done. You'll see so many successful traders around the world earning a living and making money in the foreign exchange market. But this is not something that's going to simply be a get-rich-quick thing. This is not going to be a lottery ticket. This is something that's going to become a part of your identity. You're going to become a day trader. You're going to learn how to trade. You're going to learn a brand new skill where you can then open up this phone. And as long as you have this skill set, you can now participate in the market and start to earn profits. And the more you make is going to be dependent on how serious you become and how far you're going to take your education. That's the difference here. All right. Now, as we move forward, if you guys want to actually get involved in the foreign exchange market, we have to talk about, well, how do we get involved? Right? Because there are we need two elements to actually get involved in the Forex platform. One is called a broker and one is called a trading platform. All righty. So what's the difference between a broker and a trading platform? Right? So you want to get involved in the FX market. You love it, right? You want to come here, you want to trade. Well, how do you do that? Well, let's talk about it. So the first thing that you're going to need is a broker. So a broker and a trading platform are different components to the financial trading process. Each is required to participate. So what is a broker? A broker is a person or a firm that acts as an intermediary between the buyers and the sellers in the financial markets. So anybody of any age in any country around the world, in order for them or you to get involved in the Forex market, you will need a broker. Brokers are going to facilitate the buying and the selling of the assets. So when you want to buy gold, when you want to sell gas, when you want to buy GU, when you want to sell EU, when you want to buy crypto, when you want to sell crypto, you will need a broker. And the brokers are going to provide various amounts of services that you need. And how the brokers make money is the brokers will often charge fees and commissions for their services. So you always pay a little bit of a fee to take every single transaction, right? It does not cost money to get involved with the broker. It will only cost money to actually fund your account. So if you want to trade, the broker will say, hey, we're open for business. Bring me 100, bring 500, bring 1,000, bring what you have. And you can take any trade that you want. But every single time you take a trade, there's going to be a small cost. And you have to make up that cost, and then the rest is all of your profit. That's how the broker works. Now, a trading platform, the second component, right? The trading platform is a software application or an online service that provides a virtual environment for traders to execute their trade. For an example, if we're looking over here at this platform is known as TradingView. TradingView is one of the largest digital platforms in the world right now. So this is not a broker. This is a trading platform. This platform allows me to see the markets. I can see the current value of Bitcoin to the US dollar. I can see the current value. I'm on the DXY, which is the dollar. I can see the value of the dollar, right? If I come here to the gold market, right? I can see the value of gold in real time right now, okay? So that's what the trading platform is, okay? So this offers real-time market data and analytical tools and order placement functionality, okay? And traders use these platforms to monitor the market movements, analyze what we're looking for, and then place buys and sells, right? So as an example, if I open up my phone right over here, let's say I open up my phone and I come over here to my phone, I'm able to open up, oh, this is the wrong one. Let me grab this phone. I'm able to open up a platform, right? Here goes a trading platform from my phone. Now I can use this trading platform on my phone to analyze the market. Now I can also trade from my phone in the market. So you see here, this allows me to actually trade and enact transactions. So you need a platform and a broker together to actually participate in the market. Pretty simple. Now, from here, as we keep going, let's actually start to dive deep. Okay, we covered a little bit about what is Forex, who's involved, how big Forex is, right? And how you need a trading platform and a broker to actually get involved. Now, let's get into a little bit more of the details in the market. All righty. So what we're going to introduce you to now is we're going to introduce you to something known as candlesticks. So what is a candlestick? So a candlestick is a visual representation of the FX market price fluctuation that displays the high, the low, the open, and the closing price for a specific period of time. So that means that a candle, you can actually see the high, the low, the open, and the close of the value of a specific asset that you want to trade, whether it's a currency, gold, silver, oil, cryptocurrency, for a particular time frame. So if you want to see what it looks like on the 1 minute, you can. You want to see what it looks like on a 4-hour time frame, you can. You want to see what it has done for the day, you can. We're going to show you guys that in a minute. The FX candlesticks provide a range of information about currencies and price movements, and it helps us as traders to make informed trading decisions. So we use candlestick charts as a useful skill, and this can be applied to all the different markets. Now, typically, when you're looking at a market, you'll see 2 color candles, which is a green candle and a red candle. If we see a green candle, this typically represents a bullish market. So a green candle would mean that the market opened and then the closing price closed above the open. So that means the value of that asset has increased. That means that Amazon opened at $1 and Amazon closed at $3. There was a gain in that asset. Now, if you see a red candle, the red candle represents a loss in value. So as an example, let's say Amazon was valued at $10. It opened, but then it closed at $8, right? So there was a $2 loss in value. So whenever you see a green candle, this means that the market is increasing in value. Whenever you see a red candle, this means the market is decreasing in value. So as we come over here to the market, what we're looking at right here is we're looking at a candlestick chart. Now, if we're looking at the candlestick chart, remember, the market has opened right there and it closed below. It opened and it closed below. It opened and then it closed below. If we look at this candle in real time, here is the market open. And because the US dollar is currently losing value in real time right now, you see that this candle is still open, right? The wick over here is the high. It means that that's how high it went. But if you look here, this means that this is how low it went. Now, as you see how the candle is still fluctuating? So it's still an open running market. There's about 2 minutes until this particular candle closes because this is a 5-minute candle. So right now, every time you see the little wick, that's the low. That means that that's how low it went. But wherever this candle closes, that's where you're going to see the candle close, right? Or over here. This is where the candle opened, and then that's where the candle closed. This is how low it came to the wick, but it ended up closing right there. So this is how we're able to read candlesticks. So now when we look at candlesticks, candlesticks also have different time frames. As an example, if I come over here to the daily, you'll notice and you look at the chart looks a little bit different, okay? And the reason why is because if you look over here, this means that every single candle is representative of a day. So this means that today the DXY opened here, the dollar opened here, and currently it's still dropping for the day. So for the day, we're losing value right over here. Okay, give me one moment. Perfect. All right. If you see a green candlestick, this means that this is where the market opened. Okay. This is where the market opened, and that's where the market closed for the day. But if we take this here and we start to zoom into it, we say, okay, what if we don't want to see the day? What if we want to see 4 hour? Well, we go to the 4 hour, and now we can see each candle's 4 hour. We can go down to the 1 hour, and now you'll see that there's more candles, right? And you can go all the way down to the 1 minute. And on certain plans, you can even look at the seconds. So candlesticks are going to help us look at the market and see what the market is doing. Is the market going up or is the market coming down? So when you start to see a series of red candles overall coming down, that gives us an understanding that the market is losing value. When we see a continuous series of green candles, we know that the market is continuously gaining value. Okay? Now, let's come back over here. So this is a candlestick. Now, how are profits actually generated in the market, right? So if you want to come in, you want to buy or sell a currency in the market, you understand that candles are going up and going down. Well, okay, so how are profits? How do I actually get in, and how is the money made? So in the Forex market, individuals make money by trading one currency for another. So remember, currencies are quoted in pairs. You always need 2 pairs because you're buying one and you're selling another. Okay, so we are making money by trading one currency for another, and we're aiming to make a profit from the change in exchange rates. So traders analyze the market to predict whether a currency will strengthen or weaken against another, and then buy or sell the currency pair accordingly. Pretty big words, right? We'll show you how simple that is. So there are 2 different positions that you can trade in the market. Now, the reason why the FX market is so big and so volatile, and why so many people love to participate, is because unlike the stock market, in the FX market, you can make money in both directions. You can make money when the market is going up. If you put a buy when the market is going up, you can earn money. If you put in a sell when the market is coming down, you can earn money. Whereas in the stock market, you can really only make money if you're buying a stock and then the value of that stock goes up. Because when the value of the stock starts to go down, you're losing money on it unless you're selling it off to another person. Okay, so this is how it works here. You can make money in both directions. You can buy and you can sell, and you can make money in both directions. So in the market, whenever we want to buy, this is what we call a long. You might hear day traders say, hey, I'm going to go long in the market. Well, what does long mean? Long means I'm going long, baby. The market is going up. That's what I'm looking for. I'm looking for the market to go up. I want to buy in the market, and I want the market to go up. That's a long. Now, when we want to sell in the market, some people might say sell. All right, but day traders, they will often call it a short. They say, well, what are you doing today? Well, buddy, I'm shorting today. This market is about to drop like a hot potato. I'm selling all day, all night long. I'm selling in this market. That's a short. So a buy is a long, a short is a sell. Okay, a buy is a long, a short is a sell. Now you can capitalize in either direction, and as long as you have forecasted the market correctly, you earn a profit. Now, if the market goes in the opposite direction for what you're forecasting, that's when you begin to lose money. Okay, so this is how it actually works. So let's say we are looking at the market right over here. Okay, and let's say we were looking at the market from a technical standpoint, and as we are looking at the market, we're saying to ourselves, one second, we're saying to ourselves, you know what, Tom? You know what, Tom? I'm looking at the market, and I feel like the market is going to sell off today. I did some of my technical analysis. I did some of my fundamental analysis. That stuff you're going to learn later. I feel like the market's going to come down today. So I'm going to put in a short inside of the market. Okay, I'm going to put a short in the market. So this is where I'm going to sell. This line right here, that's where I'm going to sell. If the market is going into the red, I'm losing money. If the market's going into the green, I'm making money, right? So if I'm a trader and I want to sell in the market because I feel like the market's going down and the market did go down, I have made money. Now, if I'm looking at this market and I'm saying, you know what, Tom, I actually think that this market is going to continue going up. I don't think this market's going to come down. So I'm going to go for a buy in the market, right? I'm going to go for a buy in the market. That's what I'm going to do. I'm going to buy in the market. Now, if you're putting in a buy in the market, this means that you are anticipating this market to continue to go up. You're anticipating these green candles to keep kicking in and going up. But you know what happened here? It didn't go up. The market turned against you and the market started going down. Now, if you are in a live trade right here, if you're in a live trade and the market's going in the opposite direction, so if you put in a buy and the market drops, you're losing money. If you put in a sell to go down and the market goes up, you are losing money. You can only make money if you're trading in the direction that the market is going. So you have to buy when the market's going up and sell when the market is going down. And that's why we have strategies and tactics. And these are the things that you learn because it's not rocket science. It's a blueprint. Okay. So these are how profits are generated. Now, what is a pip inside of the market? What is a point inside of the market? So the point is the unit of measure to express the change in the value between two currencies. This is what we call a pip. A pip is like a 100 to a 1,000% of a penny, okay? Which is absolutely absurd, okay? So as an example, if we're looking at something known as Euro USD, and the Euro USD goes from 1.1005 to 1.1006. So if it goes from 1.1005 to 1.1006, the market has risen in value by 1 pip. The market has went up by 1 pip. Okay. So let's actually come over here to EU. So let's say we're looking at EU over here. So let's look at EU in real time. Okay. And if we're looking at EU, the current EU market is at 1.06120. This is what the current EU market is at right now in real time at the time of this webinar right over here. And remember, the euro is the euro to the US dollar. Okay, this is a major currency. So if we want to understand, well, what is the real exchange rate? So what we do is we look at the 2 letters before and after the currency right over there. You see this? So right over here, this represents that the actual dollar to the euro, there's only a 6 cents difference as of right now. The euro is only worth 6 cents more than the United States dollar at this current time right here, right now. And this is a good trick to know because let's say you're going overseas. Let's say you're going to Mexico or someplace exotic, someplace beautiful. Let's say you're going there. And you know, when you go to the airport has a foreign exchange. And they say, hey, we'll transfer your currencies to this country's currencies. And they'll let you know what the exchange rate is. So as an example, I can go to Mexico right now and they'll say, hey, the exchange rate is $1 to 16 Mexican pesos. So for every United States dollar you give me, I'm going to give you 16 Mexican pesos. But I could come over here and say, hey, the actual exchange rate is 1 to 24. I don't want 1 to 16. It's 1 to 24. I want 1 to 20, right? Because what do they do at the airport? What are the foreign exchange? They actually make money off of you. They make a few dollars in the transaction, right? Most people don't know this. They've been doing this to you your whole entire life, every single time that you guys are trading and traveling. Okay. Now, after, if we look at the 2 decimals after, okay, if we look at the 1 and the 2, that 1 and the 2, that right there is called a pip, right? So the 3rd and 4th decimal is known as the pip. So when 12 goes to 13, the market has risen a pip. When it goes from 12 to, let's put it over here, when the market goes from 1.06113, the market has went up a point. When it goes to 1.0614, the market has now went up another point or 2 points. It goes 1.0615, 15, the market has went another point. Okay. And we are able to see the pips in the market, obviously, by right here, by looking at the right-hand side. Now, luckily, we have something known as a toolbar, right? We don't have to pull out calculators and do math. When you come to the trading, you will have a little measure bar, and the measure bar will instantly tell you how many pips the market has went. So as you see from, let's say, from this current price all the way back up to this high point right over here, this market at this price is going up 70 pips. So think about it like this, right? Or let's take a look at this candle, right? Let's take a look at this euro candle. This US USD candle right here is 47 pips. So this is a 4-hour candle. So that means in 4 hours on this time, on this day, in 4 hours, the EU market went up 47 pips. That's a great amount of pips for the market to go up. So if you had placed a buy right down here, you would be 47 pips in profit. So think about pips like footsteps, okay? If you are at point A and you want to go to point B, right? You have to take steps. 1, 2, 3, 4, 5, 6, 7. And every time you take a step, you are progressing to your end goal. That's how I look at the market when it comes to pips. Every pip that the market moves is a step. So every time the market's going up another pip, the green candles are getting bigger and bigger and bigger and longer, and they're going high. Every time the market goes a pip, that's the market taking another step, rising in value, going up. That's how you can look at pips. And every pip life matters. Why? Because every pip has an assigned value. So when the market moves pips, you make money. So we're going to talk about that next. Okay. So we're going to talk about next something called a lot size or a position. So if you are trading within the financial markets, okay, and you want to make money, right? You're going to say, okay, let's come over here. Let's come back over here. Let's take a look at this market. I'll give you a great example. So today we had a trade idea for gold, right? So we did a trade idea for gold today. Okay. And then what we did today was we came over here to gold and we said, okay, this is a potential place where we can enter inside of the market. And we would like to see this gold market, you know, come up. And I didn't give an exact stop loss, but let's say we're doing something like 75 pip take profit and a 25 pip stop loss. So let's say we're doing something like this. Okay. So the first thing that I did was I said, okay, I created an analysis. The analysis helped me forecast what direction the market was going to go. Okay. So now once I did that, the first thing that I'm looking for is I'm looking for the price, right? I'm looking for the entry price. So let's come over here. Let's actually make that a bit larger. Okay. See that black line? So what we're going to do is we're going to actually introduce you at the same times to entry, stop loss, and take profit. We're going to introduce you to all three of these right now, including the lot size. So let's say I'm over here in the market. I want to enter. So if I want to enter, I need to find a specific price to enter. That specific price is known as my entry price. So if we come over here, let's take a look. What is an entry price? The entry price refers to the price at which a trade is initiated. Okay, that's simple. So if I come back over here, okay, this right over here is the exact price that I'm looking for the trade to be initiated. So this price here is this price right over here. So let's actually create a text, right? Let's make that black and let's just make that larger. Okay. So there goes my entry price, 1993.880. That is my entry price. Okay. Now, from here, if this market wants to, if this market's going to go up in this direction and I want to earn money, I have to enter a position at this price. Okay. So as we come back over here, we have to enter a position or what we would call a lot size. Okay. So now a lot size is going to determine how much a trader is going to make or lose per pip the market moves. Remember, those pips are footsteps. So as the market is moving up or down, you're either making or losing money, depending on if you're buying or selling. All right, this is a measure to communicate the quantities of currencies transactions. So as an example, it's much easier to say I'm trading one lot than saying I'm trading 100,000 of a US dollar to the euro. All right, that's too many numbers. So we keep it very, very simple. So there are three lot sizes. Now you can trade in between all these lot sizes and as high as you want. So let's start with just the three most popular ones. So the first lot size is something known as a micro. A nano is actually the smallest lot you can ever trade, but in traditional day trading, you'll never be able to trade a nano. So we're going to look at something known as a micro. So the micro is the smallest position that you can trade. A micro is when you are leveraging what looks like a 0.01. Okay, you're leveraging a 0.01. You'll learn about that in the next training. Okay, so what this basically means here is that every single time the market moves 1 pip, you're going to earn or lose 10 times the amount you are leveraging. So if you're going to trade a 0.01, you will make or lose 10 cents per pip, like USD, 10 cents USD per pip that the market moves. If you trade something known as a mini is a 0.10. So if you're looking at American dollars, it looks like a 0.10. It looks like a 10 cents, right? Which is not valid, right? It's not the actual way to trade it, but visually, that's what it looks like. It looks like 10 cents, but that's not how it's called. So it's a 0.10. So if you have a dime, if you have 10 cents and you take 10 by 10, right? If you have 10 dimes, what do you have? You have $1. Okay. Remember, you're always going to make or lose 10 times the amount is going to be 10 times the lot size that you're trading. So on a micro, if you're trading a 0.10, you will make $1 per pip. Now, let's say you go to a full lot. A lot means you're trading a 1.0, and that means that you will make or lose $10 per pip. Okay, so let's come over here and then let's take a look at this gold market over here. Okay, all righty. What's going on? Okay, there we go. So let's say we're looking at this gold market. So let's come over here at this gold market. So we had to get in at this gold market at 1993.880. Okay. Now let's see how much we would have made on this particular trade. So if we're looking at positions, let's actually draw up the positions over here. Okay. So let's see our position, aka our lot size. Okay. So if I had a 0.01, that is the equivalent to 10 cents per pip, right? So that's that. And then if I have a 0.10, that's a mini. That means I would make $1 per pip, right? The market's going to move. And then if I had a full lot size, that means I'm going to make $10 per pip. Now, if you want to get a little crazier, let's say you were trading 10 lots. If you were trading 10 lots, then you would make 10 times that amount. You would make $100 per pip. So let's see how much money hypothetically you could have earned if you were in this trade at this time. Okay. So from this entry price until the highest point that market went, it said 666. That's a little sketchy. So let's go a little bit higher. This market went about 68 pips in profit. All right. So if that went 68 pips in profit, that means that on a 0.01, you might have made $6.80. Okay. You would have made $6.80. That's not too bad. Okay. If you were trading a mini, you would have made $68. Pardon me. You would have made $68. If you were trading a full standard lot size, you would have made $680. All righty. And now if let's say you were trading 10 lots, you would have made right over here, you would have made $6,800 on that trade. So as you see over here, the game is the same all across the board. It's all about looking for where we're going to get in and if we're going to buy or where we're going to sell. How much you make is going to be indicative of how much you leverage. How much you leverage is going to be indicative of how much money you have, like how much equity you have in your broker account. So as an example, if you have a $100 broker account, a $100 trading account, you're not able to leverage $100 per pip. You would margin out. So that's what you're going to learn in some of your next tradings before we conclude this training, right? So your lot size is always going to be, it's always going to be in proportion to your actual balance. But how much you make on every single trade is going to determine what position size you took. So I'll give you a great example, right? We were looking at gold, and just last week, okay, or actually 2 weeks ago, going on actually almost 3 weeks ago, we actually got into a buy on gold all the way down here, okay? We got into a buy gold down over here. Now, this was about 3 weeks ago. We all got in together on the session. We were looking at it. I said, hey, this looks like a good trade idea. And if you guys liked it and you guys want to take it, you can take it at your own discretion. So from here to here, this market had risen almost 2,000 pips, right? 20,000 pips. That market has risen almost 20,000 pips. So if you was in that trade, that means here you would have made 200 bucks. Okay, here you would have made 200. On here, you would have made 20,000. On here, you would have made 200K. Okay. And here you would have basically made $2 million. Now, did you need $2 million to be there? No. If you're at the right place at the right time with the right lot size, you'll be surprised how your Forex account can exponentially grow. This is what everybody's always trying to capture inside of the market. Now, moves like this will not always happen, but these are the actual possibilities. That's why showing up in the market every day, learning the skill set and putting yourself in a position to be profitable when the time arrives is so important. And what does it really take to take an hour a day to learn FX trading or getting in the live market? Okay. Now, as we go into the final portion of today's trading, we're now going to properly introduce you guys to entry, the stop loss, and the take profit. So in trading, the entry, the stop loss, and the take profit are essential concepts related to managing trades. In summary, entry is the point at which the trade is initiated, as we showed you. A stop loss is the level at which potential losses are limited. And a take profit is the price level at which profits are secured by actually closing the trade. Okay, these concepts are crucial for effective risk management and maximizing potential gains. So what does that mean? That means that if we were to, let's come back over here. All right, that's a lot of moving around. Let's come back over here. This means that if we're looking at the market, right? Let's say this was our entry price. So just because you enter a market, that doesn't mean that the game is over. Every single trade is going to require something known as a take profit. Let's put the take profit here at 60 pips, right? And then let's put the stop loss at 30 pips, right? Okay. So every single trade is going to require an entry, a stop loss, and a take profit. What does this mean? This means that you will take this number right over here, which is the entry. You will then look for this take profit number, which is right over here. So this take profit number is this number. We'll copy that. We'll put that right in the text. There goes your take profit. And then we'll take a look at our stop loss. Okay, so let's take a look at our stop loss. Let's copy that. Let's put it right in the text. These are the three most important numbers that you're looking for. The entry is the price that you're getting in. The stop loss does exactly that. It stops the loss. So let's say you're in a trade and you're saying, you know what? I'm willing to risk $30 on this trade to make $60 on this trade. And this was your entry price. So this means that this is where you are in the market. Now, let's say that this is a bad trade. It goes against you. No big deal. Losses happen. So this means that if the market starts to go against you and you start losing money, you're not out the trade. You're still in the trade. This right here is called drawdown. Drawdown is when you're not profitable on your trade, but you're still in the trade. So all hope is not lost, because sometimes from the drawdown, the market can swing around and become a win. Okay. But what would happen is, let's say you're at work. Let's say you're sleeping. Let's say you're with the kids. Let's say you're eating at the gym, doing anything, and you're not able to look at your chart. And you say, okay, I'm going to swing this trade and I'm willing to risk up to $30. But if it hits that $30 mark, that's it. I'm out. I don't want to risk any more than that. So if the candles actually come and cross and hit your stop loss, it will automatically stop the market at $30 and protect the rest of your account. So if you have a $200 account and you hit the stop loss, your account will now become $170. No big deal. You live to trade another day. Now, a take profit does exactly that. It takes profit. It means that if the market goes in your direction and hits your TP right over here, it will automatically close your trade with this $60 profit. So if you had a $200 account, it means that your account will now close at $260, and you have now made some profits in your account. And you don't have to look at it. You don't have to manually close it. It will do it on its own automatically. We as traders, we will never jump in and trade in the market without a stop loss or take profit. Anytime we look for an entry, we're always looking for our risk and we're always looking for our reward. And you guys are going to learn more about that, because with proper risk to reward, you can be an abysmal trader, winning quite literally. If you're doing a 1 to 10 risk to reward, you can win 1 out of every 10 trades you take, and you can still be profitable by the end of the week, right? So most people think you have to be this guru and this maniac in the market to make money, and you have to watch all these news reports and do all this crazy stuff. And it's simply not true. Different people look at the market different ways. There's different ways to analyze the market. And I can guarantee you, and I can promise you guys, that if you begin to work with us on a more professional level, you will learn strategies, techniques, styles. You will learn what fits for you. And most of us are trading about 1 to 2 hours a day. That's really all we need to be able to generate the income that we have. But that only happens once you know how to trade. And in order to know how to trade, this is where you begin. Right over here in this FX Breakthrough Bootcamp and some of the additional training videos that you have. So with that being said, guys, we are going to conclude today's FX Breakthrough Bootcamp training. Again, this is part 1 of part 5. So we had a fantastic intro and crash course into the market. You guys can feel free to watch this replay as much as you want to grasp what you learned here today. But if you want to continue learning, I encourage you guys to show up to our very next course. Show up to that course, and we're going to continue to give you the skills, the tools, the education that you need to succeed in the Forex market. So my name is Manny Quinones, and I want to thank you so much for being here with us today.